In this video, traders, we are going to look at the new, or reasonably new, micro E-mini contracts. What are they all about? The advantages and disadvantages for the retail trader. Stay tuned. Hey guys, warm welcome to you. All right, so they're not that new. They've been going around a few months, but there seemed to be some confusion about what they're all about and whether they're any useful, whether you should be trading them or not, especially for you future traders and especially also for you Forex traders, because this might be a game changer for currency traders out there. All right, so if we look at what they are, in May 2019, they were launched on the CME, these new additions, 4 new additions to the micro E-mini contracts. So traditionally speaking, the E-mini contract, the most popular one is going to be S&P 500, or otherwise known as the ES, is the code for that. Hugely popular, loads and loads of volume on it, one of the most popular vehicles for day traders. Then you've got Nasdaq 100, Russell 2000, and the YM, which is the Dow Jones 30. Obviously, they're all tracking those underlying indices. And the E-mini is generally the way that people get exposure via futures to the indices. Of course, there's the ETFs, etc. But the issue was for smaller retail traders, not necessarily smaller traders either, just newer traders. It was sometimes quite a large commitment to make when you've got volatile markets. You know, if you think of the Dow, for example, which is $5 a point, you know, if the market's swinging 300 points in a day, well, that's quite a lot of risk for someone who just wants to try it out, who just wants to get their feet wet, play around with a live account, not just a demo account. And so there was always that issue of, if I want to trade futures, I've got to kind of step up and really kind of put more money to work. And there's also the issue of scaling. We'll get to that in a moment. So what they've done is CME have said, right, okay, no problem. What we'll do is we'll do a 10-to-1 ratio. We'll launch these products. We'll call them micros, and they'll be basically a tenth of the size of the E-mini. So the new codes are for S&P 500, MES, MNQ, M2K for the Russell, and MYM for the Dow. So basically they're a tenth of the size. So they worked out by saying, okay, we take the standardized E-mini tick size, and that's the way I like to work it out. I think it's the best for retail traders as well. We know we work in ticks and points and movement rather than valuation of the contract per se, and also the margin. So they take the tick and then they go, right, a tenth of that. So S&P 500, one tick is $12.50, and remember, that's a quarter of a point technically. So because the whole point is $50. So the mini is $12.50 a tick. The micro is $1.25 per tick, so it's a tenth. So you're getting much less of a movement financially if the market is swinging wildly. Same if you look at the YM, for example, rather than $5 a tick, you're down to 50 cents a tick. So that 200, 300, 400 point daily move, it can be stomached for somebody with a small account or someone who wants to try out some strategies, etc. So the advantages and disadvantages. Oh, by the way, guys, the margins, according to the exchanges at the moment, are between $500 and $600 per contract. It might be different if whichever broker you're trading at. Some have intraday specials, etc. But that's the order of magnitude. So let's look at the advantages and disadvantages, whether you consider trading them or not. So the first thing is that, those of you who are based in UK or in Europe, we've always had access to a smaller product via a spread bet, via a CFD. We can trade, pound a point, 50p a point if we like, and go right down and trade those, which is a synthetic market, but generally they're tracking the underlying market. But our friends over in the US and other places haven't always had access to this, or maybe don't want to trade a synthetic product. Maybe you don't want to trade a CFD or spread bet. You want to trade directly on an exchange and do it properly and consider kind of upgrading to the E-mini once you've kind of got a strategy that works. So, this all of a sudden this allows you to do that. Of course, the biggest advantage is the fact that you could trade smaller size. You can trade the smaller size, you don't have the swings. The second advantage is a scaling advantage. So if you were trading, let's say, one contract, there's always a saying, isn't there, that it's actually, very hard to trade one contract versus two. And the reason for that is that you have the ability to scale, of course. If you're trading 2 lot, 4 lot, 6 lots, you've got the ability to take some off into a move, scale some out, trail some, leave a little runner on. There's so much more flexibility than just one in, one out, which is often what traders have to do when they're trading the E-mini. Now that game's changed. Now if you're trading 2 lots, for example, and you're just about getting kind of going, you can trade so many more underlying micro contracts. You can choose. You can either trade 10 times the amount if you want to get the exposure or not. And then, of course, if you want to spread your positions around, you can have a little bit of a pair trading opportunity that may not have been available to you before because of margin requirements. You want to trade 4 of these instruments, now you can. The other kind of disadvantage, though, guys, is the volume. So there's volume there at the moment. I've been watching it, having a look. It's not near, obviously, the size of the E-minis because they're still going to be dominant, especially stuff like the ES. But there's volume there, and there's probably enough volume to trade on for the average retail trader. Obviously, if you've got more, you're going to go straight to the mini product. You're not going to trade the micro. Some things they're saying from institutional level, which is probably not relevant for us, is you can get more control over things like hedging your delta exposure on options, so you can really be granulated with that. It doesn't matter too much for us. I just think it's the ability to trade more contracts and have scaling and less exposure if you want it is the big thing. The other small disadvantage, which is to be considered, is the commission. Now, I've had a little look at some of the big brokers and they're varied, right? But there don't seem to be a tenth of the commission. In other words, you'd expect if you're paying 60 cents or something, you'd expect it to be 6 cents, but it's not. It's normally about half. Okay, so, and obviously it's going to depend on when you're watching this video. It's going to depend on so many stuff. That game's changing all the time. That arena is changing all the time. So you've got to be aware of that. Your costs to trade this are a little bit higher. So you've got the pros and cons. You kind of say, okay, well, if I'm the advantage of being able to scale into a position, having less exposure, having a smaller contract size versus paying a little bit more for it, you need to weigh up the pros and cons of that. Now, obviously, if you're micro scalping, that might be prohibitive. You're spending quite a lot to get in compared to like the regular E-mini. You might want to do it. If you're day trading over a few hours cycle or trying to get the main move of the day, or if you're swing trading it, then paying an extra 30 cents on a contract probably not going to be a deal breaker for you. So have a look. And guys, if you're trading Forex at the moment and you're trading kind of different Forex size lots that they've got out there, all of a sudden now something that's traded directly on the exchange, so it's regulated, all the other good stuff that comes with trading on an exchange, and also don't forget you can be working your orders, you can put all bids in, you put offers in, you can get hit by anybody else's. It's the beauty of trading on exchange. How much opportunity there is there being a less liquid contract than the E-mini, I don't know, but it is still there. So it's maybe something to consider. Now, all of a sudden, you don't have to be having massive exposure to the market you didn't really want. You don't have to be having, massive swings just for one contract when in reality, you wanted to have a position, you want to kind of have a bit of wider stop with it. Now you can do. And the final thing, guys, of course, is if you're swing trading with futures and you're saying, well, listen, especially with the market swinging around, I need a kind of 500-point stop on the YM, or I need a 50-point stop on the S&P 500. With one contract, that might be prohibitive for your account size. All of a sudden, now that becomes another strategy that you can employ. So more strategies, more flexibility, more opportunity to adjust your scaling, less exposure, lots of good reasons to take a closer look at those. How much they take off and how much volume comes into them, it remains to be seen, but we shall see. I think they're a good idea, and pretty pleased the CME has done that. Really opens up the kind of game for people who want to get involved directly in the market, on the exchange, on the CME, without playing at the full size level. All right, guys, take care. See you next one. Bye-bye.